Let's talk about investment in fixed income. Where are there opportunities from your point of view?
By the way, I hope it's a correction, because if I'm right, I think it took about 10 years for the Dow to get back up above 1,000 from that taping. Look, when we look at the repricing in the bond market, it's been dramatic. For the first 4 or 5 months of the year, it's been the worst bond market in history by a lot of measures. We want to take advantage of that. We think it's gone too far. I was in Kentucky visiting clients actually yesterday. There was a lot of discussion about municipal bonds. And there are a lot of individual and institutional investors that are looking at muni bonds yielded 1% at year end. They're now yielding over 3%. On a taxable equivalent yield, that's about 5%, and municipal finances actually look pretty good. The other area that we're getting back into that looks pretty attractive to us, I touched on earlier, it's high yield. You're at an 8% yield. You were at 7% at the start of the month. You were 4.5% at the start of the year. A pretty dramatic repricing, and I think a lot of investors have just fled the market and forgotten that it's a cleaner market. 6% of the market defaulted away in 2020. You've got a lot of middle America industrial companies in there with great fundamentals. To me, that's where a lot of value exists.
I want to come back to high yields, but Sarah, what about munis? Because I think you're interested in those as well, right?
Yeah, for fixed income in general, rising rates are going to be a headwind, but similar to Bob, we don't see rates rising to the degree that they have year to date. So for fixed income, there are areas where you can lean in. Municipal bonds do have strong fundamentals. At the front end of the curve, we're seeing high yields. And in taxable fixed income, we like corporate credit, those companies and sectors with strong balance sheets, but also emerging markets and high yield. You're getting a good return now, much better than you did in the past. So all of those are areas that we like in taxable fixed and munis.
So I'm really curious about the high yield, because there's a lot of talk about the spreads, as they say, blowing out on high yields. So you don't want to be in high yields when that happens. Are you confident that's not going to happen? And when you have rising rates, don't you have to be worried about some defaults?
You have to worry about defaults right before recession. And our analysis shows that any backup in high yield credit spreads is a buying opportunity unless a recession is imminent. Expecting 1, 2 years out isn't imminent, because we know anything can happen. So for us, credit quality still looks great. The yield is there. There's a lot of money on the sidelines that needs to put yield into their portfolios. As long as things remain stable, we think that money will come in and support the market.
Sarah, you mentioned earlier some of the equities you're interested in. You mentioned energy, for example. You mentioned Microsoft, maybe Costco. What makes you interested in those particular sorts of equities?
So within energy, we love the fundamentals of the sector: tight supply, strong demand, producer discipline. Particularly refiners, we think, can benefit at this point in the cycle. Within the FANG stocks, we don't think that they're dead. You just need to be selective. Look for ones with less competition, more of a unique business model. Not only Microsoft, but Amazon. They had a very tough quarter, but they've really, in a sense, overinvested in their logistics. They have so much control over their global distribution. It's going to be a positive for them and pay off in the long term. We don't look at Amazon as a post-pandemic stock that's just going to suffer from here. Other areas of equities, consumer staples is an area where people tend to hide during periods such as this. They have very low growth rates, though. Valuations are high. That's not a place that we would be looking. If you want protection, look for those companies with strong dividends where they have the balance sheet strength to continue to increase those dividends.
So Bob, on the fixed income side, is there a corporate bond sort of tracking of what Sarah just said on the equity side? Are those the corporate bonds you're most interested in?
I think it's just so broad-based now. Everything got thrown away. I wish I could say there was a particular market or sector, but everything cheapened up so dramatically. It's just a matter of going in, having the nerve to buy when everyone else is selling, and just hanging on for a little bit and ride through the volatility.
But what if, in fact, there is more of a chance of recession than we're anticipating? How do you hedge against that? How do you protect yourself, Bob?
Well, I think there are a couple of things. One is you have to go up in credit quality, because if, in fact, we do go into recession, then you are going to see default rates go up. Then there's going to be a flight to quality. So not only do you want higher quality corporate bonds, you want government bonds again, regardless of the yield. We've seen that yield could be anything in the government bond market, and then you want to still stay in the dollar. So those are the kinds of things where you would go to if recession became really probable near term.
So, Sarah, what about the dollar? I mean, we heard there Mr. Rookheiser 50 years ago talking about the dollar. Boy, we've had a very strong dollar. This week we saw maybe a little bit of a backing off on the strength of the dollar. Do you have a theory on the dollar, and how does it affect your investment strategy?
I hate to say anything different than Lou Rukeyser, but we're in the camp that the dollar should remain pretty strong. The U.S. is the safe haven trade. There's so many geopolitical risks out there, from the Russia-Ukraine situation to the lockdowns in China and the supply chain issues that they're having, and also can that monetary policy really have an impact? So we're very selective non-U.S. We only like Latin America at this point in emerging markets. Dollar remains strong as the U.S. raises interest rates. We think that at best it's flat. That likely remains pretty strong going forward.
Sarah, I also want to ask you the same question I asked Bob. On the equity side, for example, if you thought there was a larger chance of recession than you've said so far, how would you hedge against that?
Well, first of all, I think market time is a loser's game. The market can turn on a dime. We've seen that happen consistently this week. So we don't recommend people trying to get in and out of the market. This is where you need to be diversified, disciplined, averaging into the market. And then you just need to look for those companies that are resilient in those sectors where they can continue to perform well because they have the profitability, they have pricing power to overcome inflation, strong free cash flow, strong balance sheets. That's where we'd be positioning in equities. Stay out of unprofitable technology companies where they might have a hard time surviving during a deep recession.
And Bob, sort of finally, Warren Buffett and others have said you want to buy when others are selling, and the reverse, right? Right now, as you look at the marketplace, where are people selling that you'd like to buy? They're making a mistake.
Well, I think we talked about corporate bonds. I think that was a big mistake. I think there was a lot of selling of municipals. I don't think that was a mistake. I think that was the technicals because they had to raise cash to pay capital gains taxes at the start of the year. I think some of the emerging market debt sectors look pretty attractive to me.
I'm glad you raised that because I was going to ask about outside the United States. You think emerging markets might be attractive on the fixed income side?
Yeah, because they've gone through a rate adjustment. If you look at the U.S., we've done 2 rate hikes for 75 basis points. If you look at the emerging markets since the start of 2021, we've had something like 130 rate hikes for a cumulative 11,000 basis points. There are high real yields there. They front run the inflation. They're in a good spot.
So, Sarah, same question to you. Whether it's debt or equity, emerging markets do you find attractive? Some people say this is a time to move into them. Others say they've got a lot of external debt.
I'm going to agree with Bob and say emerging markets debt over emerging markets equity. I think you're getting more for your yield there. Emerging market equities are tough because of what's happening in China. The impact of Russia and Ukraine on European equities, we're very selective there. India looks somewhat fully valued to us, so we're finding most value in Latin America, which is out of the fray. But it's a challenge for equities in emerging markets at this point.
Let's sneak one last one in quickly, Bob. What about China? At the very end of the week, they really cut their rates, and particularly mortgages. Is that good news for the world?
No, it's bad news, and I think you have to look at it and think that the probability of stagflation goes up a lot because they're struggling with vaccinations, they're struggling with the spread of COVID and mortality rates. They're going to lockdowns pretty systematically, so the supply pressures are going to continue and consumption will decline.